the incoming panel will look at some of the wholesale applications. So it will build a little bit on the discussion that we had just now with Claudine, but we'll continue to look at it more in the context of Capital Markets Union. So more broadly, market integration, securities market integration. Helping us in that discussion is Kirsten Winters, who is the Chief Risk Officer of Ostra, one of the important fintech, I should say tech companies, providing the post-trade infrastructure and derivative markets. And he will lead an excellent panel, which consists of, see whether he's in yet, not quite, yeah. I might then actually pass over to you, Kirsten, I see you, good, to lead us into the panel itself and introduce the other panelists. A smooth transition as always.
Thanks, Nick, and thanks to you and the team at Afore for asking me to moderate this panel today, which I'm extremely happy to do. And we've got a great set of panelists for you. So what are we focusing on in this panel? Well, we're focusing on the role of technology in making Capital Markets Union a reality. As everyone knows, the EU is in the process of building Capital Markets Union, and technology has to play an important role for this to be successful. But it also reminds us that the markets are indeed global by their very nature. This panel is going to explore how technology is changing wholesale securities markets, structures, and specifically the panel will look at how we can foster transparency in those markets through things like ESAP and consolidated tape. But we also hope to touch on topics such as DORA, trading venue perimeter, and PFOF. So plenty to keep you entertained as we go through. And ultimately, we hope to answer the question of how does technology contribute to the objectives of CMU? But before we start, I'd like to ask the panelists here to introduce themselves. So Martina, can we start with you?
Yes, thank you. My name is Martina Tambucci. Probably many of you already know me. I'm the head of the international relations at Consob, working at the security regulator since a long time. It is several years that I follow all evolutions in the area of the digital finance, as well as regulatory updates linked with digital finance, as well as Capital Markets Union, which is actually an important part of this panel, as well as other regulatory interventions in the European Commission agenda.
Thanks, Martina. Jeff?
Hi, everyone. It's a little early over here, but I'm in the US. My name's Jeff Brown, and I run the Charles Schwab Corporation's Office of Legislative and Regulatory Affairs. I'm based in Washington, D.C., and I have been with Schwab for many years, 20 years now, and we're obviously a large broker dealer in the U.S., bank and asset manager, and happy to contribute to this panel.
Great, thank you, Jeff. And Yorick?
Yeah, thanks for having me. I'm the CEO of Pax. Pax is a neo-broker located in Amsterdam, London. We are the largest neo-broker in the Benelux, one of the fastest growing in Europe. We offer access to retail investments for natural persons, really trying to, of course, disrupt the investment space and really trying to open up the markets to make investing more accessible, intuitive, and affordable for everyone.
Great, and finally, Rui?
Thank you very much. My name is Rui Almeida. I'm head of the Conduct Division, the Financial Services Department in the Ministry of Finance. I'm responsible for following up the European legislation on financial service for the last 7 years, been working on the more traditional financial services such as prospectus, MiFID, and UCITS, and more recently on these more innovative topics such as MiCA and DORA. I'm very happy to be here. Thank you.
Great, and I'm Kirsten Winters. I work for a company called Ostra, which basically focuses primarily on post-trade activities of connectivity and processing in the OTC capital markets and ETD markets. And I'm the Chief Risk Officer. So we'll get started. So, Martina, maybe we'll start with you. Can we have a view from a regulator as to how technology is being used to promote CMU more broadly?
Yes, thank you, Kirsten. Very interesting question to start this panel. As already mentioned, it is very much concerned with the CMU. So allow me to start by saying something on it, though very briefly. The action plan, which was lastly reviewed in 2020 by the European Commission, is actually an attempt to revitalize the European capital markets through measures aimed at stipulating both the demand and the offer for financial products, thus channeling financial resources towards entrepreneurship projects in a context of maximum level playing field with a view to reduce room for regulatory as well as supervisory arbitrage internally, and ultimately with a view to make Europe more attractive from abroad. Faced with such an ambitious plan, one can question what is the role of digital technology, or if digital technology is actually a role to play? Well, in my view, technology actually kicks in 3 different ways. More generally, when elaborating regulation for the financial sector, but I think it applies also to Capital Markets Union. First, regulation can be laid down with a view to cater for the peculiarities of the technology so as to balance risks and benefits, probably at a very different point of equilibrium than in the case of traditional businesses. Second, regulation can promote the use of digital technology. And in this respect, a prominent example is that of the DLT pilot regime, even if not actually being specifically as part of the CMU, but it is definitely part of the digital finance agenda by the European Commission. And a third way is when regulation foresees the realization of central hubs and other centralized projects through the direct use of digital technology. And I do believe that in that respect, the ASAP project plays a very important role within the Capital Markets plan, Capital Markets Union plan, for a number of different reasons. It definitely goes beyond the other sectoral hubs, like this consolidated data provider, for instance, because ASAP is meant to collect all available information that can be processed to the end of adopting investment decisions. And importantly, it extends to ESG-related information, allowing comparability in this area, which is of the utmost importance to avoid greenwashing and other distortions. But what I would like in this context to specifically highlight with respect to ASAP is the technology underpinning the initiative, which in my view appears to be quite revolutionary in the context of the European legislation on reporting and disclosure. It follows a previous attempt to bring the benefits of the blockchain into the financial sector field. And this previous pilot, I would say, goes under the name of the European Financial Transparency Gateway. I don't know how many of you are friendly with this system, but it is a pilot project to use the blockchain to set up a central repository for the so-called regulatory information. So all the information that need to be provided according to the Transparency Directive, the Market Abuse Regulation, and bring together as participants and co-owners several national officially appointed mechanisms, the so-called OMs. So ASAP, I wanted to recall this previous experience because ASAP is sort of evolution. And why I say this? It is actually conceived not as a traditional database, but rather as a single entry point where information is accessible through being automatically redirected to where the information is actually stored. That is to say, at the level of the so-called collection bodies, which might be the officially appointed mechanism I was making reference to before, as well as any other public or private databases. This innovative architecture, in my view, has the potential also to drive additional technological advancement Europe-wide, as it will force further harmonization and standardization of formats of information that companies disclose to the public, and will certainly increase the availability of matching readable data, because that is the goal at the end of the day, as well as will pave the way to big data analysis and extensive use of artificial intelligence. It only remains questionable whether it will really be used by all types of investors, by this way bringing the expected outcomes that are, on the one hand, an increase of the information available to investors, reducing search costs for investors, and thus prompting a higher demand for financial products. On the other hand, it could contribute to a race to the top at the level of the companies, subject to EU laws, in turn prompting higher quality on the side of the offer of financial products. And this brings actually to my previous argument on the perimeter of ESAP extending also to ESG information.
Thanks, Martina. Great setup, I think, for this panel there. Do you want to pick up maybe on the ESAP point briefly before we move into CTP and some of the other topics?
Of course, and I think that Martina has already laid down the key points, which I fully subscribe. And indeed, the three ways the legislation tries to tackle these digital innovations that Martina presented, I think that they were very accurate. And I think that on the specific legislative initiatives that compose the Capital Markets Union packages, I think that there is this sense that we live in a digital age, and therefore information is a major asset. And I think that today we will address at least three different legal acts that tries in some way to promote this information and safeguard it, either through the MiFIR consolidated tape that we'll address further regarding how this information is distributed, the DORA requirements on how to safeguard this information, and as in the sense how to ensure an easy access to this information, and the type of information that Martina mentioned, and information promoting subjects such as sustainable finance. How can this information be a tool to establish the European Union as a front runner on these subjects, and also how to foster the use of metadata and provide it to artificial intelligence in the financial services. This is one of the key objectives of the ESAP, and I would just like to complement with two key elements that I think that will be very interesting to follow during the development of this ESAP file. And I think that the first one is how to ensure the confidence of the users of this platform, because ESAP is very ambitious, and I think that one key topic is to prevent the establishment of its rushed implementation, because maybe if we have a too ambitious approach, and this platform in its beginning of implementation does not provide the accurate information or it's not available with the quality patterns that consumers expect, it will be very hard to reverse these sentiments by consumers that will try to seek alternatives. So I think that this is one of the key balances that we'll face in ASAP, how to ensure an appropriate phase-in that provides confidence in this tool. And the second element, and it's always a matter of balancing approach, is the role of the collection bodies. Because the collection bodies, they will have the key task of storing the information, assessing its validity, its quality, and providing it to the ASAP. So they are between ESMA, which will manage the platform, and its users. And it will be, in order to strike an adequate approach, the costs that these collection bodies and the way as they are responsible or liable for the end result of the information provided, I think that this will be a topic deserving major attention, and I think the right balance is necessary on this regard to ensure an appropriate establishment of ESA.
Yeah, I think phasing is always the key on all great initiatives. So it's a great point you make, the first point there. Okay, so let's, topic close to my heart. So CTP, before we dive into it in the European context, maybe Jeff, you've been at this for years in the US. So do you want to give us kind of the state of play in the US and the pros and cons and what we should be doing and what we shouldn't be doing in Europe from your perspective?
Sure. When it comes to the consolidated tape, I think the first thing you have to do is decide what is it you're going to use it for? What's the purpose of the tape? And is it to be a post-trade review mechanism so that you can determine, whether there's been compliance with best execution or other rules that may apply to any particular trading venue? Or is it to be a source of data for investors so that they can understand where their trades may be executed if they seek to trade? And it's from that second perspective that I'd like to just focus, because at Schwab, that's what we've always believed, that the consolidated tape should be as advanced and provide the data such that retail investors can see the same information as professional traders. Their orders are equally valuable as any other order that goes into the system. And so in the US, the way the system developed, obviously, we've had a consolidated tape since the late 70s, and the exchange has always controlled it. But for the first 15 years or so, the broker-dealer industry sat on the boards of those exchanges. And so there was a control over the pricing and content of the consolidated tape. But as technology advanced and as exchanges morphed into for-profit public corporations accountable to their shareholders, the development of proprietary feeds, faster feeds, richer content, became a wonderful product for exchanges to sell, while at the same time, regulation required us to buy the consolidated tape and to show the consolidated tape to our clients at the moment of trade. Even though that product, the consolidated tape, grew slower and slower in relation to the proprietary feeds, it grew out of touch, and to this day, the content of the consolidated tape in the US is the same as it was in 1978. So, the product, that's been a real problem for us. And in the last few years, we had some success where we were able to get the SEC to adopt rules to include depth of book into the consolidated tape, and to include odd lots, so that particularly in securities, there was a time when many securities were very high dollar value. Amazon, Google, the predominant amount of trading is in odd lots. It's in less than 100 shares. And so, so that was going to go into the tape. And then we were able to obtain rules that changed the governing structure of the committee that oversees the consolidated tape, such that the industry would for the first time get a vote on fees and content. Well, you can imagine the exchanges went along with it. They were dragged kicking and screaming to not allow this to happen. When it was adopted, they sued. We had litigation and went before the courts, and the exchanges were successful in removing the ability of the industry to have a vote on the content and pricing of consolidated tape. But the other features went forward. So, I mean, I guess in baseball terms, you know, it was a triple, not a home run for the industry. And in a sense, that's where we are right now. We are hoping that we can get some of these changes implemented. Now, of course, we have other things going on now with our market structure. I don't know if you've seen what our SEC has proposed, but that's going to take up all the oxygen for change, and it may take some time. But I guess I'll just go back to one. You can't allow the same entities that are going to, the exchanges most predominantly are going to be providing the data to control the content of the consolidated tape, as well as controlling the content of their proprietary feeds. You can't allow them to control the pricing. Now, I don't know how that's going to be done in the EU, but if those are not distinct from each other, you will end up with the same type of lagging consolidated tape product that becomes more and more latent and is less useful to our clients as a resource for investing. So I'll leave it at that.
Thanks very much, Jeff. And so, I mean, I guess I would note at this point, you know, the consolidated tape debate is very different for equities versus bonds versus derivatives. And here we're going to kind of focus in on equities. So, Yorick, if you could kind of react to Jeff's thoughts, and then give your view on you know, what we should be doing in Europe with regards to the CTP for equities.
Yeah, it's a good point, right? I think when we talk about a consolidated tape, I think it's by default already quite an ambitious project, given the fact that Europe obviously is completely fragmented, and the US is, of course, one overall, you know, one exchange effectively that made, of course, the consolidated tape a reality very, very early. I mean, I think the consolidated tape in the US, when you look back and when it got started, we talk about 50 years. You know, technology developments have been massive in the meantime, and therefore there's a lot of opportunity that we can use and apply. There have been a lot of mistakes that, you know, along the way in the US as well, that the EU can now leapfrog and can make sure that we don't make those similar mistakes. I think in the end, I'm a big fan of a consolidated tape, but it needs to be done right. And there are a lot of touch points where I believe that the consolidated tape can play a significant role. Not only can it help in creating a level playing field and make sure that obviously there's a lot more transparency, security, best execution, but there's also a lot of you know, underlying aspects that play a role with regards to inducements, PFOF, for example, that are all, from my perspective, also linked to the consolidated tape. So I think in the end, we need to make sure that we create an approach that works for everyone, remove the hurdles that create such a fragmented landscape. And obviously the CMU, ESAP, and all those kind of initiatives help significantly to get us in the right direction, all for the sole purpose of creating a level playing field. Now, I think that, and Martina already indicated this in her opening statements, you know, there is technology with regards to the blockchain, for example, that's a lot more sophisticated than you know, the old-fashioned technologies that were applied in the US when the consolidated tape was just created. Now, if we can, of course, leverage off some of these more technology developments and they use those technology developments to create a consolidated tape that is simple, straightforward, and easy to subscribe to, then I think we've got something that's very, very powerful. I also want to react to one specific point that Jeff made on the consolidated tape and the purpose of the consolidated tape. If you look at, Jeff, you mentioned, for example, that there are two reasons why a consolidated tape can play a significant role in the securities industry. One is best execution and everything that comes with it, making sure that people are somehow protected in a way that they get at least execution at the right price, but also transparency. Where are my trades being executed? The depth that the consolidated tape can bring. I think in Europe, the focus at this point should still be on the first, not so much on the latter. Why? Because we're still in the early stages of setting up a consolidated tape. And I think at the moment, due to the fragmentation, best execution is actually quite an issue. It's just very, very difficult. And any regulator can attest to that how can you make sure that a client actually gets execution at a price that's fair or at a price that's the best? It's just very difficult to assess that due to the fragmented landscape and the different exchanges, multilateral trading facilities, and even SIs that are now playing a role in this European landscape. So I think that the consolidated tape can solve that first and foremost. And obviously, if we can link that up to, and we'll hopefully get a touch base on this a little bit later in this conversation, Kirsten, if it can help with the discussions around PFOF, inducements as well, create a level playing field there, then I think the consolidated tape is a must-have in Europe, and we need to move fast. Not too fast, because indeed we need to make sure that it works, but with the newest technologies, I'm sure we can get there.
Yeah, I mean, it's an interesting point you make on PFOF and inducements. I mean, maybe, Martina, we could get your reaction to kind of that topic now, just conscious of time.
You mean the CDP and PFOF?
Yeah, the PFOF point Yorick raised, and also the inducements angle.
That's actually what I wanted to pick up of what Yorick just said, and not necessarily the PFOF, because to be honest, I wouldn't have anything to add, because I also think that CDP is essential to ensure the possibility, on the one hand, for financial operators to operate in the best interest of clients, and then offering them best execution. And on the other hand, it is meant to allow also supervisors to verify on an ex post basis whether best execution was actually granted to end investors. But if you allow me, I would slightly move away from the PFOF debate and introduce a new but close one, which is that of inducement that Yorick also mentioned. And I'm interested in this because it is a new debate that is starting to gain attention at the European level, because we're on the verge of the adoption of the EC retail investment strategy, which is one of the pillars of the renewed CMU plan. And the debate still started about whether to prefer the so-called commission-based model in the distribution of financial products, as opposed to the fee-based model, where a crucial role is played by the approach to be preferred to remunerate the financial advice to investors. I would want to refrain from providing a political position at this stage, but would rather focus on the role that I see for technology in the area of the financial advice. I have to recognize that it has the potential to change significantly the terms of the discussion, and I'm going to say why. Definitely, technology used to provide financial advice to end investors has the potential to reduce the cost faced by such investors when approaching the capital markets. Now, strange it might seem, some behavioral economic studies demonstrate that investors do trust artificial intelligence, for instance, in the context of the provision of financial advice, even more than financial advisors. And these studies also demonstrate that many behavioral biases typically seen in human-human interactions do not occur, or at least occur to a lesser extent, in human-artificial intelligence interactions. If we combine this empirical evidence with evidence of a reduced cost for benefiting of a certain degree of advice provided in a technologically advanced manner, it is clear that technology can mark the difference in the debate about inducement when it comes to decide whether to allow or to ban the receipt of inducements. But I will stop here and see if there are other points of view on this controversial issue.
Does anyone want to jump in on inducements?
Yeah, I can share my opinion on inducements. Look, we were regulated in the Netherlands, so there's a complete ban on inducements, obviously, and PFOF is from that perspective a part of the entire discussion. But it's interesting. We, of course, have been looking at the markets quite extensively. We've had conversations with literally all the national competent authorities around this as well. From our perspective, a full ban on inducements and an advisory type of solution makes sense. I think historically in the financial sector, we've had quite some issues by providing certain inducements to certain firms or allowing certain inducements in certain firms, which led to just bad financial advice purely from a commercial perspective for the clients. Now, in a self-directed environment, though, and if you look at purely look at execution-only services, I think there are ways in which you can still allow certain inducements. You can still allow PFOF if you do it the right way. And therefore, the most important thing here is that how can you use technology to make sure that you still operate in line with the best interest of your customer, while not making sure that obviously firms are being penalized for not having the possibility for inducements. Inducements, from my perspective, are still a large discussion point. But the most important thing that people sometimes forget is you want to make sure that people get access to the financial markets more and more, especially from the what I call the less affluent segments in retail. There is a large shift happening with regards to pension systems, with regards to inflation right now, low interest rates, and for people to get access to the financial markets, where Europe is still very, very much behind in comparison to a more sophisticated market like the US. We all have a job to do to open up that market for those people and to make sure that the accessibility improves, the affordability improves, the inducements can play a role. But it needs to, of course, be in a level playing field. Otherwise, you get a regulatory arbitrage. And it needs to be in a way where technology can solve the solution for the conflicts of interest that arise from it.
Thank you. And just conscious of
Kirsten, if I might, just to follow on with what Yorick was saying, in the U.S., obviously we have a substantial retail investor base, unlike any other country in the world, frankly. At Schwab, we have 34 million retail investor accounts that we provide custody for, and so it's an important part of the ability of Americans to save for their future, and so we have to provide that, and we have to the provision of payment for order flow has allowed the brokerage industry to move to zero commissions. It's a low-cost entry way into the marketplace, and there are concerns here. We're having a big debate right now about payment for order flow, and the SEC has put out proposals that they seek to ban it without banning it. They don't want to say they're banning it, but they'll make it so difficult that you'll have to not accept it. But it's really it's an implicit fee. And the SEC would be fine here in the U.S. if you had explicit fees back to commissions. They don't care, because they're not really trying to advance investor interest. What they're really trying to do is move order flow from off exchange to on exchange and eliminate payment for order flow. So we're going to have this debate, but I agree with Yorick. If you do it in the right way, we disclose what we're going to be paid on orders as we route them to the execution partners that we have. And our execution quality is far superior to what you would get in routing them to exchanges or to some other venue. So we're very, very confident in the way we've developed our system, and our clients have shown us that by the numbers that have come to us. So we're ready for that debate here.
Right, and then just in the interest of time, we've got 4 minutes left. So I did want to, with the events of last week, I did want to touch on DORA and operational resilience, both in the cyber impact and the rest of operational resilience. Ruud, do you want to maybe just give us a few brief thoughts on that, and then we'll move to any final comments people have?
Okay, thank you very much. And sorry for not commenting PFOF, but I'm already dealing with post-traumatic stress of that discussion in the council, so I need some time. But on the inducements topic, I think that I just can briefly mention that regarding the AI used in this context, it will be very interesting to know how some of the challenges that we face on the inducements will be prevented through AI, because if an entity has the incentive to provide certain service or product instead of execution-only product, how would AI ensure that independence if that AI is developed by that company that is involved on such inducements? And also the data that regarding inducements, of course, each side tries to share the one that benefits most its views, but I think that I don't know, maybe Yorick, there is here an element that should always be taken into consideration in inducements, at least from countries such as Portugal, the type of investor, is that regardless of the assessment of the adequacy of the advice provided, whether it is the perfect one or not, whether the inducements increase the investment, as the access to investments, it's always a major point to take into consideration. Regarding DORA, very briefly, and just to wrap up this matter, I just wanted to bring it because in my perspective, this is the first legal act with a hybrid approach regarding both financial entities and digital services providers, and this is an unprecedented take, and through DORA we will be able to see the interaction between European supervisory authorities, the ESAs, and digital services providers. In order to deal with these challenges and this new approach, there will be created 3 new supervisory bodies: the Oversight Forum, the Joint Oversight Network, and the Joint Examination Teams, each one with different functions, but all aimed at ensuring a coordinated approach at EU level regarding the interaction between financial services providers and these big critical digital services providers. And finally, we will also see the implementation of a new power that could be implemented by national competent authorities of financial services entities that may, as a last resort measure, determine the suspension or the termination of the legal binding relation between the financial entity they supervise and the digital services provider providing services to that entity. So I think that we are living very interesting times, and I'm very excited to see how this new approach will take place in practice.
Sure. Look, I think there's a lot of innovative ways in which we should approach, especially the post-trading bit. And of course, Kirsten, I know that you're quite experienced in that field. We see still that the fact that we're dealing with clearing, settlement, T+2, yeah, it's almost not from this day and age anymore. And if you also look at ways in which you can still get best execution, but you do internal pooling, for example, you can reduce costs significantly. All those kind of old-fashioned ways in which, at the moment, still clearing, settlement, and all these processes work. Yeah, we need to use technology, I think, to not only create a level playing field, but also make sure that in financial services, we just improve on the entire end-to-end process that will save costs. It will also create a process that's a lot more lean. Overhead will be reduced. And I think that is, if I may, at least bring something forward, that's where a significant amount of effort should be put into innovation.
Great, thank you. No, I totally agree on that last point, and reduces risk as well, which is obviously key. Thanks everyone for joining on the panel. Hopefully that was an enjoyable topic, huge topic to cover in that amount of time. So we just about managed it. So look, hand over to you, Nick, and to Stephen, and have a great rest of your conference.
Really well done. Excellent panel. Thanks so much, Kirsten, Martina, Geoff, all of you. Jeff, thanks for getting up this early in the morning. Really appreciate it, and also Raoul. Thanks so much.